earlier we were talking about the spreads, legging into the spreads, and we're talking about how I'd like to see an overvalued or undervalued option. Fernando says, how do you see in Power Options tool if an option is overvalued or undervalued? Well, you can do it from this chain. You can do it in most any of the searches, or you can do it directly from the option quotes page. The two filters that we'd be considered using if an option is overvalued or undervalued is sort of the implied volatility over historical volatility range. Sorry, let's go back here to the search. Implied volatility versus historical volatility. The IV-HV ratio. What it's looking at is the implied volatility of the option compared to the historical volatility of the stock. If it's greater than 1, let's say my IV-HV ratio was 1.10, that means the option is considered 10% overvalued based on its implied volatility of the option compared to the historical volatility of the stock. Undervalued would be less than 1. Okay? There's also the IV over SIV. The SIV is the average implied volatility of the option surrounding your current option as well. The second one is the Black-Scholes ratio. This is the actual trading price of the option divided by its theoretical worth. It's Black-Scholes theoretical value. If the Black-Scholes ratio is greater than 1, the actual trading price of the option is greater than theoretical, it's considered overvalued. If it's less than 1, it's considered undervalued as well. So in a calendar spread that I removed, unfortunately, let me go back to other strategies for a moment. Let's take out naked put. Let's put in calendar calls. Fantastic. Let's go to that search. So as I mentioned, if I want to look for an option, oh, where is it? Where's my Black-Scholes? There it is, Black-Scholes ratio, sell and buy. Okay, so what I could do is I want to look for an option that is considered overvalued to sell and less than 1 undervalued to buy. None. Even though it's a diagonal right now, other positions, well, this isn't a good search to use. Let me go further out. Let's just use calendar leaps number 1. It's a more open search here. Now let's reverse it. Black-Scholes ratio sell option greater than 1 for overvalued, less than 1 for undervalued. Let's go ahead and run that. Remember, in a vertical spread, it's very difficult to see that because both options have the same expiration date and they're on the same stock. If one's overvalued for an expiration cycle, the option that's 2 or 3 strikes away from it is overvalued as well. But see, here we have some August versus January, 2021 on Abercrombie, where the short option is considered greatly overvalued and the long option is considered undervalued. Doesn't mean it's going to be a better trade. It just means that if it works out, you might get more bang for your buck. If implied volatility shifts, you might get more bang for your buck as well. Okay, so that's the field. Now, as I mentioned, if I go to the option chain, I'll just link to it from here, but of course you could always just put in your stock symbol up at the top and click on chain. So in the fields here, looks like we already did this, IV over HV, looking for anything greater than 1 is overvalued, less than 1 is undervalued. That's a bad view to look at because those are the options expired today. Let's just go straight to September. Perfect, okay. All right, so you've got IV over HV, 50% overvalued, 60% overvalued, Black-Scholes ratio. That makes sense, right? 2.7, 2.4, 2.6. Okay, so Abercrombie, recent movements in the stock, the near-term value options are overvalued, the far ones are undervalued. That's how you do it. You can use it on the search to look for IV over HV. You can see it on the chain, or if you looked at the individual option, I'll just take the 18 strike, go to research and call or put research there from that menu. Down here you see your Black-Scholes and Black-Scholes ratios. Okay, 20-day Black-Scholes, 50-day, 100-day and more. IV over HV, IV over SIV, the average of the implied volatilities, and the current percent implied volatility range. That makes sense, doesn't it? It's overvalued compared to implied volatility by 60%. Black-Scholes ratios have it overvalued, and the implied volatility of this option is at 93% of where it has been over the life of the option, the percent implied volatility range. Well, of course, everything should be overvalued. This should be overvalued if that's the case. But those are the 3 ways to do it. You can do it on the search. You can take a look at it on the chain, or when you're researching it, you can go to that option research tool. You can see it right here as well. IV over HV, Black-Scholes ratios. All right. So again, I apologize that I wasn't showing the numbers there for the tool, but we took a look at that earlier. All right, so we got about 3 or 4 more questions remaining. I'm just scrolling down to the end. There we go. Okay. So first question, this might take a moment, but it's a management question, looks like from Darrell. It's like I was signed a 50 strike option. Oh, sorry, my pen just died. Okay, so that's there. All right, so I was signed a $50 option, 100 shares at $1,000 loss. I sold an ATM at call at 51, and it is exercised. Well, you're assigned, right? Yeah, you sold an ATM call, signed a $50 option at 100 shares. Okay, I'm kind of confused on this. I'll use Dell as an example. Let's go back to the custom spread tool. It's the terminology that I think we're struggling with. So you said you were assigned at the 50 strike call, and then you exercised the 51. Now, this doesn't have a 51. I apologize for that. It should have chose a weekly. Let's just use the 52.50. So when you say assigned, that means you sold the 50 call, and you exercised means that you bought it. So this would be a bit, what you're talking about is a bear call credit spread structure. You said, are you liable for the difference? Well, no, that's just your loss. In order to be assigned at this strike and exercise at this strike, 51, okay, that implies that the stock's trading at 52, 53, 60, anywhere above this strike. So you don't have to cover anything else. What happened was you were forced, if this was a call, you just said option, but you were forced to essentially go short shares of stock here, but you had the right to buy shares of stock at 51. You lose that $1,000. It's not that you're liable for it, it's already covered. In your account, you essentially bought shares of stock at 51 and you sold them at 50. There's no other liability, you just have the $1,000 loss, the difference between the strike prices. Okay, I hope that answers your questions. You would have had to cover the margin in this case. Looks like a bear call credit spread. If it was puts and it was done at a debit, well, you bought shares of stock assigned on the short at 50 and you sold them at 51, is that right? Yeah. No, you forced someone to buy them at 51 here in this case, and they're at 50, but that would have worked because it was the debit spread. But in this case, if you were calls and you were signed here and exercised here, that means both calls were in the money. You lost on the bear call credit spread. Oh yeah, if it was a bear put debit, they both just would have expired worthless, right? Because they'd have been out of the money. So essentially what happens is if you were exercised and assigned, exercise means you bought shares of stock at 51, assigned means you had to deliver them at 50, so you lose the 1 point between times the number of contracts times 1,000. It's not that you're liable for it, it's that you likely would have already had that covered. Your broker would have had you cover the margin as well. Edison's question. Okay, so we're going to take a little different tack. I hope that answers your question there related to this, Darrell, regarding it. You lost $1,000 on the trade. You didn't have to cover everything else. The margin requirement was already there. I'm going to pull up Nugget real quick. 39.89. This is related to married put position. Okay, so let's say back the other day I bought, oh, no, I wanted the other one. Let me go back home. I'm sorry. Let me go back to the main homepage. I wanted the one that increased well today. I'm going to cheat on this one. Here we go. JNUG. That is the one. I wanted to use JNUG, not Nugget. I wanted to use JNUG. Okay. In any case, JNUG was up today, of course, $11. That might be too much. That's too extreme, but we'll put in different numbers. This is 89.04 is the short and long of it. So let's say I entered a married put several days ago on JNUG, and I bought shares of stock at 83.50, and at the same time I bought a 6 or 7 month output following what I do. It's let's just go to March, and I purchased the put option, let's say the 88 strike put wouldn't have been $29.45 at that time, right? It would have been slightly different, probably around, actually the price of the, yeah, it would have been a price about the 82, so it would have been about 25. Expensive, but again, keep in mind that this is a 3 times ETF, so everything's going to be overpriced. So let's just put in $25. Very expensive for the 85 put, but it's a 3 times mark, okay? Yeah, risk is 18.9. Let me just use a better, I'm going to stick with this example, but let's just say we paid $9.25, okay? I'm just doing the math in my head. Yeah, there's a 5.1% risk, a standard married put position. Now, Edison's question is, in a radioactive trade, married put position, after the underlying approaches the strike of the put, it's at 89.04, we're at just above our 88 strike right now. Can we go ahead and sell a bear call spread, what we call income method number 6, one of the 12 different income methods, at or above the put strike price, or do we wait for the underlying to be above the put strike and then sell the bear call? No, I could, this is a little bit above, okay, but I could, right now if the stock's trading near the put strike price, I want that short call that I'm going to use for the bear call spread in this case to still be above the strike price, at or above the strike price of the put. That's what's in the blueprint. Right? That's one of the rules in the blueprint. So my put's 88, but I could sell the 89 and buy the 95, for example, as the bear call spread on top of the married put position, as long as it matches what I need to see. And this is talked about in the blueprint as well, meaning that I want to see something like this. Now, if this was a non-3 times ETF and I got $1 for the 89 call and I paid 65 cents for this, we had a 5% risk to begin with. We generate a 35-cent net credit. This still looks pretty good, okay? But what you may see it sometimes is if your premiums aren't that great, or you're trying to form a weekly spread too soon and the stock is at the put strike price, if adding your income method number 6, that bear call spread, does this where you go back to negative before you come back up, I don't want to see that. Okay, what I want to see, the proper income method number 6, yes, I can do it right here. Now that the stock has moved up, I have some gain here. I can do it right in this, sell the one here, buy the one here, and I want to see something that looks like this. This might be too extreme for me. I don't want it to get too close to that loss area again. The best income method number 6 graph, done correctly, would do something like this, okay? That's what you want to see. You do give up some, but then you don't give up a lot, and you're here right now. That's what you want to look for in that situation. So follow the guidelines in the blueprint. It's spelled out right there in the income method number 6 chapter of what you would look for in that scenario. You want to wait for the stock to move up. You can sell it right at the put strike price, but it doesn't hurt to go higher if you still get the premium you want. All right, so that's related to the married put positions, a protective radioactive trade, and of course one of the 12 different income methods, a way to generate income. But when you do the bear call spread on top of the married put, you don't have to put the margin up because you already own the stock, and it leaves the upside open, unlike just selling a call. And that's one of the 12 different income methods that we discussed for managing the radioactive trade that's described in the blueprint. All right, let's see here. I didn't get the name on this one. Oh, it was Darrell again. It says, back in the day, I vaguely remember research testing done to see what percent profit is most profitable. Let's say 100 trades close at 25, 50, 30, or 70. I can't remember who did it and what the result was. The 25% closures were the most profitable. All right, so what he's asking here is Darrell came across something that said that you vaguely remember research testing to see what percent profit is closing the most profitable. Let's say 100 trades closed at 25, closed at 50, 30, and 70. Okay, so I just placed 100 stock trades. And what's the best profit if I consistently can get 25% returns, 30% returns, 70% returns? Which one turned out to be the best? I don't remember this. I don't think it was us that did this. Seems like 25% closures are the most profitable. Does it sound possible or reasonable? I'd have to look at the rest of the discussion, because what I think they're saying is simply this. Let's go to radioactive trading and let's look very quickly at the trade simulator. And let's assume a stock purchase, okay? And what do I mean by stock purchase? Let's assume that we're going to take a 50-50 shot of being right, okay? Or that we're going to close and make 10% when we're right. Okay, target for, let's see here, sorry, 10%. I'm sorry, hold on one sec. Okay. So the probability of loss 50-50, flip a coin, we're going to make it. Now let's say that we're going to assume that we lose 20% when we're wrong, but we make 25% when we're right. See, now this is where things get cagey, okay? So I make a 25% profit, whether it's on a spread, whether it's on a long option, flip a coin 50 times, and of course we take 50% of our trading capital each time we do a trade. We lose 20% and we're wrong. In this case, we can be right more often than wrong. We can be wrong more often than right and still roughly make money. Now here's a good return at 55%, and so forth. There's 44 and 56. Now here's the catch why I can't answer this question directly. I have an idea, Darrell, but I can't answer it directly, is because you have to formulate something. If you're looking for returns in the 50 to 70% range, you may be doing deep out of the money options, let's say buying deep out of the money long calls, that have a lower monetary risk. You're still risking 100%, but it's only a small percentage of what you were doing if you were buying an in-the-money call for a higher price. But you also have a lower probability of success, right? So I take 3 long calls. We have a stock trading at 100. Now I'm expecting a 70% gain. Well, if I buy a 110 call out of the money for $1, so 110 straight call, premium's $1, I probably only have a 30%, 25% probability that the stock's going to move up to this strike, and I might see that 70% return. Okay, the at-the-money 100 might run me $5. Well, now I'm at a 50% probability the stock might move up or move down, and I might get closer to my break-even. The probability is at 50, but I might only be seeing on average, using at-the-money long calls, of a 40% return as opposed to the 70% return. And if I go to the 90 strike call, it's going to cost me $12 to $13. Okay? Now, I can't get it with only a 5, 10%, 15% movement. I might not see that 70% gain. Well, 10% movement, I might not see that 70% gain on this position. It would be at 110. I might be at 20. That's $7. I'm at about 50% gain with the deep in the money call. And of course, it's going to run us $13, as I mentioned. We've got a higher probability of the stock staying above the strike or maybe moving up to the break even, potentially, because it's at a lower break even, because most of this is intrinsic. Break even here is at 105. Break even here is at 111. Break even here is at 103. But again, the probability of getting a 50 or 70% return is very low. I'm probably likely to get a 25% return. So this target you're talking about has to take into account, in my opinion, if I'm only looking for a 25% return on long calls, I might expect that to get that 60 to 65, maybe 70% of the time. If I'm looking for a 70% return, I'm only looking to get that 40 or 45% of the time. If I'm looking for a 50% return, I might only expect to get that 50% of the time. It's a trade-off. It goes side by side. So I can't really answer that question. I will tell you this, though. When I'm talking about straight spread positions, where I'm looking for my target of 15% average winners on my bull puts, and when things go against me, I control the losses to only 48%, meaning I have a 2-point spread, I control that to a 1-point loss. But I'm looking for that 83 to 87% probability. Okay, I'll invest a third of my allocation to each trade. And so my target is around, let's say, the 84% range. Now, most of what I see, there's an also popular discussion out there that says when you get 20 to 50% of your expected gains. So let's say I took in a 50-cent net credit on a 4 or 3-point spread, which would give me this 16, 17% return, for example. So that's a 3-point spread. I get a 50-cent net credit. That when I can liquidate this and take 25%, I should take, or 25 cents, excuse me, I can close it for 25 cents because the stock moved up. I should take that and make my half of what I expected to make. Okay, now I have a problem with that. In my actual trading with a credit spread, they talk about taking 50% of the profit off early. Okay, in my back testing that I've done and the historical testing we've done, when I do this, what ends up happening? I lower my target return down to almost 9%, maybe even a little lower in some markets. Why? Because yes, I'm still making some of the full profits that I held open to 15% average return, but the others I'm cutting down to 7% because I'm closing them early and then paying the extra commission. So this average drops down to about 9% or so. And a lot of these that were hitting 15, so let's say 65 to 70% of them could be closed for 50% gain. So most of them are getting closed at 7% after you factor in the extra commission. So I'm lowering my average return. The ones that lose typically start to lose right away. I'm still wrong 16, 17% of the time and losing an average on 48. So what have I done to my track record? What have I done to my trading plan and my targets? I've lowered this down to 7. It didn't increase my win ratio and my historical testing. Why? Because the ones that lose 16, 17% of the time lose very soon and never got a chance to get to that 50-cent profit. I keep the same almost amount of losers. It doesn't increase for me. And this, I've cut the gain down in half. So when I run that scenario, of course, and put in an average of about, we'll be nice and call it about half, we'll call it 7.5%, 82% win ratio, I'm down 67%. 91, all right, I'm still making money, but I got to be right 91% of the time. 79, 85. I'd have a 35, 40% return if I was right 85% of the time, averaging 15% on wins, losing 40% on losses. Lowering this down by cutting the gain out early, which is kind of related to your question about should I be closing at 25% profit, could I have been closing there? My historical testing has found that this is lowered too much, and now I actually need a better win ratio to be profitable long term, because I still keep the same losers that went against me in the first 5 or 6 days and never reached the 50% profitability of my expected return. Okay, so I don't know how to answer your question directly, but I wanted to always mention this when I see things about spread positions where you want to close when you get a 50% of your expected profit to close it early. That personally didn't work for me. Okay, all right. All right, let's see here. Earl says, Michael, I have to run, but I'm very impressed with your presentation. He didn't say this, but I'll say it for him, even with the fact that I forgot to show the spread chain and the screen was paused when I was running through it. And anyway, Earl goes on to say, very impressed with your presentation. I will send you an email for copies of the slides. Thank you for the recording and answering my questions. I thought he did it. Okay, he says, I do have one more question. I'll ask by email. I apologize, ladies and gentlemen. He does have another question he's going to ask, but that's via email. I thought he had another question tied into that, but it doesn't appear that Earl did. Okay, so as I mentioned, today's presentation was recorded. I might put in some screenshots over that discussion we had on the spread chain tool when the screen had locked up. I am going to cut out certain, not cut out, we're going to separate it into sections. We're going to take Paul's question first on legging into the debit and credit spreads. Then we're going to jump right into the discussion on the synthetic collars and why a credit spread over a debit spread. Might keep all of that together, but then parse out some of the other ones as well. So we'll have 2 or 3 separate webinars for you this weekend, possibly by Sunday, possibly by Saturday, by Sunday night. Of course, I just want to remind everyone here, if you have any last-minute questions, go ahead and send those in. I do apologize. If anyone has a last-minute question, we still have, we are at 5:57 p.m. Eastern Time. But, still got a couple minutes here. But I do want to remind everyone as well to send in any last-minute questions. But also, today's material are my thoughts on your questions designed for options educational purposes, increasing options investing performance, and, of course, options investing knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions or direct recommendations. I'm not opening a bull call debit spread, a calendar spread, or even a married put on KMB on Monday of next week. I may open a married put if KMB shows up in the search results again for the PowerOptions married put screen following the radioactive trading techniques. Our Fusion subscribers at Radioactive Trading will be able to see those. But right now, if that does fit and matches the trend, if it does recover from today's drop, I may be opening new married puts for the Fusion subscribers next week. Options do involve risk and may not be suitable for all investors. Okay? All right, now, another comment came through, and I want to address this comment here, of course. Oh, that's weird. It went away. I think the customer just logged out. If you haven't done so already, and you wanted to take a look at the search tool functionality with the 30 different criteria you can use for options or other screens as well for fundamentals and technicals to find your positions, overvalued, undervalued that we showed for Fernando, or even just looking at the spread chain tool. No credit card needed. Just go to PowerOp.com, put in your name and email address, and you'll have full use of the site for 14 days. I had a comment come in, but I can't scroll through it for some reason. The title disappeared. The name disappeared. Oh, there we go. Thank you. Oh, Darrell. It's from Darrell. It says, thank you very much. PowerOptions screens confuse me, which is why I haven't taken a trial. Okay, well, if you have a specific question about using the tools, let me know. There are webinars that are archived on setting up a search, navigating the site, criteria for strategies, how to use the site to find bull put credit spreads, calendar spreads, married put positions, long calls, long puts, and more. But I understand, but that's why we're here. You can schedule one of those coaching sessions at any time, but start your trial. Subscriptions after that start at about $45 per month. And of course, you can check out our blog, the webinars page at any time, or check us out on YouTube. But any PowerOptions trial member, any PowerOptions subscriber, in addition to having access to all of our education in the webinars pages, all the other information that we have as well, you can send us an email at any time. And even if you're considering a trial, you can send us an email or give us a call at any time during market hours. Also, trial members and subscribers can schedule a coaching session at any time. It's not a sales call. It is essentially what we just did today. The coaching session is a 30, 45-minute phone conversation with myself or with Ernie Zarenner. We'll walk you through the tools on the site. We will answer any questions that you have just as we had today, show you or discuss with you how we would use the tools to find positions, run comparisons that you're interested in, find trades you're interested in, do the research and analysis to make sure we have the right trade that we want that matches our trading plan, and more. We figure the site sells itself. So it's not really a sales call. It's literally with me, to the Director of Education, or with Ernie, the President and Founder of PowerOptions. So Darrell, I encourage you to take a trial. When you feel you're ready, sign up for the coaching sessions. We'll walk you through it. I'll try to clear up any confusion you have with any of the search functionalities, any of the other tools, tracking positions, and more. Well, ladies and gentlemen, thank you again for joining me today. Thank you for your excellent questions and our discussions on legging into spreads, synthetic collars versus standard, credit spreads versus debit spreads, and a lot more. One last thing, while we're here, I just want to point this out real quick. To enhance the conversations that we did have today, remember at any time you can go directly to powerop.com/webinars.asp, or you can of course click on the free webinars tab under the main home tab. But the URL there, powerop.com/webinars.asp. Here's presentations on using the PowerOptions screener, researching and analyzing a new options position, using the portfolio tools, what is behind the search criteria. For the option strategies, an old one here, but a good one, it doesn't necessarily answer the question as easily as we did it. It goes through about an hour presentation. But for Earl, there's a full presentation here from August 22nd of 17, debit spreads versus credit spreads, the comparisons of the 4 vertical spreads, why one is used over the other. But I think today we did review very well the simplest terms, why investors as a whole seem to like credit spreads over debit spreads. But here's more information on the credit spreads versus the debit spreads. There's that 8 ways to manage a bull put credit spread. Here's the managing your spread positions. You also have credit spreads, the basics, lots of other material here, selling weekly calls on married puts, a conservative strategy comparison, comparing collars to married puts and other conservative positions as well. And all of our Friday presentations are mostly right here in the requested topics section. Today's will be broken into 3 different sections, but I'll send you an email when the webinar is posted after I split it, convert it, and you'll see where you can access those on PowerOptions or, of course, as always, on our YouTube channel. Well, I think you all have heard my voice enough for one Friday afternoon. I hope you all have a fantastic weekend. Thank you again for your questions and joining me today, and we'll see you next week as we see what the market has in store for us and on our next Friday open discussion Q&A session. Take care, everyone. Good night.